Hey, everybody, it's Jeff here once again with Money Trekker Podcast. And we're having another Friday finance bonanza with Tom Kemler from BK Wealth Consulting. And we're going to talk a little bit today about the market volatility. That has picked up immensely this week. And Tom's got some things that he wants to go over, our usual charts that we go over, and really starting to talk about why we're seeing some of this volatility, specifically from interest rates and some of the concerns around that. We're going to talk a little bit about the dollar strengthening today. We're going to talk a little bit about a COVID update, which is, once again, good news. We're seeing those numbers go way, 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 way down. Of course, the inoculations are going up, which is huge. Those things hopefully will start to counteract each other. And then our most interesting thing for the day, and Tom's got a couple things for us when it comes to the most interesting thing of the day. So stay tuned. We'll be right back here in a minute. Hey, everybody, welcome to the show today. And I've got my friend Tom Kemler on. Tom, how you doing, sir?
Tremendous. Beautiful day here.
It is. It feels like spring finally. So we had that little blast of winter for a few weeks. And, well, it was a big blast of winter. And then we're right back to the wonderful world of Central Texas, which is why we live here. It's nice and beautiful and sunny and spring-like. So lots of stuff to talk about this week. We saw some volatility in the markets. So what's your take on that?
Even today.
Yep.
It really, I mean, we were, as we talked last week, just to pick up, because I remember even as we were signing off, the market was tailing off into the low for the day and the low for the week. And, some of that was end of the month stuff that you can kind of count on, end of the month, end of the week. There was definitely some going to cash in the final moments, but we've seen some whipsaws this week too, including today, particularly on the NASDAQ and the way today seems to be laying out is a pretty much a mirror image of what we saw last week. I'm seeing after a pretty rough morning, some of these NASDAQ names are just rocking right now. And we're an hour from the close, and it's given every indication that we're just going to jet on into the close and end up kind of at a mirror image to last week. I think a lot of that has to do with the yields, as we talked about last week, and I hope this analogy comes across pretty well. But and I've got a chart to show this, and it's a point I really should have made last week, which is as interest rates rise, my experience has been that people get used to it as the interest rates come up because the economy is generally doing better. And we've been talking about for many months, and we've got some more reports this week that show that the economy is still performing very well. What happens is you start to bump into these artificial ceilings of, not artificial, market-focused ceilings where a certain level makes people nervous. And Nomura Securities had a quant guy that came out a few weeks ago and said a 1.5% yield on the 10-year Treasury was going to be a problem for the market, and we hit that a week ago today, and that was part of the volatility that we saw. We went as high as 1.55% on the 10-year Treasury last week, and I would liken it to if you're cleaning out your chimney and you start at the bottom and you're running a poker or some sort of brush up your chimney. You go up so far and whoomph, a bunch of material comes down. Well, in this case, the 10-year treasury went up to over 1.5%. Whoomph, bunch of stuff fell down, including the yield. In one day, we had a 14 basis point swing, and we ended up closing out the week and the month at 1.41%. And it was that giant yank down in rates after spiking up that helped to propel stocks to their lows. Well, here we are a week later, and I'm looking at the 10-year treasury at right this very second, and it's 1.55%, exactly where it was causing a problem last week. And this week it's not causing a problem.
The world's good.
We've gotten used to the idea. And it's probably, I'm going to guess 2%, maybe something esoteric in between, but we're going to go up with that brush up the chimney. And then probably the first time we hit 2%, we're going to get a woomph. Mm-hmm. But if it's all part of a heating economy that the market can look past and say, well, we can see these rates, but we can also see the growth that justifies this heat on the rates. And then you basically, you have the woomph and then you go on. Yeah. So
and it becomes the proverbial frog in the pot, or frog in the hot pot, or the bottom, or brain not working. The proverbial frog in the boiling water. It starts off.
I was actually going to use that analogy, and I might have.
You would have probably used it more masterful than I did.
But yeah, no, I absolutely. I mean, that comes to mind is that, except in this real world case, there's some twitches. It's like, it's getting a little hot, and then it's okay. I'm comfortable again. And then it gets a little hot, but ultimately, it's not so much of a twitch as that you got to get out of the pool.
We're kind of a tepid hot tub right now. So.
Yes. And actually, I'm going to, before I share the screen, I'm going to advance to a chart. Since we're talking about this, I was going to bring this forward, and I'll go ahead and share the screen now.
You've got the cons.
That this, so this is a chart from Moody's that has the equity markets in green here from basically December of 2009 until the present. And then in the yellow, we have the 10-year treasury yield. And, you can pick this apart, but you really can't see a situation where rising yields, which, we have periods where yields rise, really cause stocks to fall apart to any great degree. Now, if you go into some nuance, you can see going back here to 2009, we did have a run up in rates, and then, there was a pullback. And I remember those days. It was a fragile recovery from the great financial crisis. And it was like, oh my God, can we handle higher rates? And so the market pulls back a little bit. In this case, treasury yields pulled back a lot. And this had a lot also to do with Fed policy and whether they were doing QE, whatever, or, some of their other tricks. But again, you don't see any instances really of long-term deleterious effects from rates hitting a certain high level and then causing the market to really come down. I mean, the big market corrections that we can see here in October of 2011. I remember that one. That was mostly just, are we going to have another great financial crisis if stocks come back too far too fast? The bond market was coming down, yields were coming down. There was concerns about growth. We had the twin summers of 15 and 16, where we had some concerns about China, and then we had this is the end of 2018. The end of 2019. The Christmas from hell. Or was that 2018? I'm having trouble remembering. It was 2018.
It was 18. Yeah, it was 18.
2018.
That's when rates were starting to crank up, and then that's when they decided let's raise rates like 4 times in a row. And
yeah, that was the Jerome Powell raising rates that one last time when everybody said don't do it.
Yeah.
And he did it, and we had the worst Christmas ever.
Yeah.
So that's what that was. And then of course you can see here COVID. But you think about those things, they don't really coincide with this one coincided with Fed policy, which is to be contrasted with the market for treasuries. I mean, they both have to do with interest rates, but they're both very different things. So again, the bottom line is that I think the chimney analogy is a good one. For those of you, don't clean your chimneys, just hang around when the guy shows up to do it for you. And it really, as you go up, it's going to cause things to come down.
Yeah.
And so it's that, each time you go up, you're going to hit a level at which it causes an momentary issue, and then it resolves itself if there's growth. And so we're seeing a lot of a ramp here. I mean, this is the ramp we've been talking about for months.
I got to give you props, my friend. You caught that bottom pretty close.
So far. But, if I'd have made that call here, I wouldn't look so good. I would have looked good for like 2 years. And I still think this is a generational low.
I think so too. You look at it doesn't become problematic I'm a chartist, so it doesn't really become problematic until you get up in the 2.5 range, and then it starts to really have some effects. I mean, we're just abnormally low at this point, have had to be because of the craziness of COVID. So we've got to get ourselves back up into the 2 range at least, which is somewhat normal.
Yeah, I'm even, even a little more. I think it's going to be 4. And I don't know how many years it'll take for us to get to 4, but 4 would clearly disrupt the 40-year chart of interest rates. There's been some fits and starts, but by and large, you've seen this channel of rates just headed lower. So I guess we'll stick with the chart since I've got them on the screen. We're gonna go back to our favorite cartoon here. We're in here telling the inconvenient truth, trying to bring these folks in. So what I did was I front loaded the only negative economic report this week that I could find. And that was the ISM Services Index. And this to me is interesting because now for everything else that it sounds like, this is really internet related, heavily internet. Institute for Supply Management, their services index. And you can see that the prior number was 58.7, and they thought it would stay the same. And, the consensus was basically, spread pretty evenly around, the consensus range was spread pretty evenly around the consensus, but the actual number came in pretty weak. I mean, much weaker than below the bottom of the range. And so, in a vacuum, that may be, kind of interesting, but there's some other stuff that we're going to see that I think kind of helps paint a picture of what's going on in the markets and why all of a sudden internet / growth isn't doing so well stock wise. the flip side to that, the manufacturing index for the ISM, blew out to the top side. And this is not new. You and I have seen this for months,
Yep.
where more often than not, these manufacturing and durable goods and things like that are stronger than expected and continuing to remain that way.
And interestingly, not talked about on the news. When you watch a lot of the financial news, they just kind of ignore it, and it's actually
because it's not bad news.
Well, of course,
Yeah, I mean,
doesn't fit the narrative that the world is in.
right. I mean, that's just we and again, what's funny, and I'll go back to this. The inconvenient truth sometimes is that things are better than you might think.
Yep.
Somehow in a world of COVID, and this is just fascinating, is that people want to hear that it's worse than it is.
Mm-hmm.
I mean, think about all of the criticism that Trump got for trying to be positive. People are like, I want to hear things are going to end tomorrow. I mean,
Yeah.
and I don't understand that, but that's just a way of looking at things. And so here we are telling maybe positive things that are inconvenient truths. So go figure. Construction spending, again, related to the boom in housing and other real estate. We have a cadence that we've seen a lot. The prior number was strong year over year. Look at that. I mean, this is all pre-COVID numbers to post-COVID numbers. And, you're seeing 5% and 6% growth, but, prior number revised higher, consensus to pull back a little bit, comes in way higher than consensus, blows out the range. Strong number. Redbook. We've visited Redbook a little bit over the years, or over the months, I guess. And I put this in. It's a weekly number, but again, this compares. It's a year over year number, and so this is for the week that ended February 27th, which is probably the last pre to post COVID. February 27th of 2020, I think, was right around the time that the very first COVID deaths were taking place. I mean, things were starting to get really, really tight, and people were, the whole beginning of the March reaction was on deck. But yet here we are with
we're officially 17 days from the first day of lockdown.
Exactly. Yeah. I mean, we got out into mid-March and all hell broke loose. But as I verified with the Redbook people, this is physical stores. This isn't just physical stores and doing their online. I mean, this is people going into physical stores, and it's 4.6% ahead of where we were right before we went into COVID. So with all of the lockdowns and restrictions that are still around nationwide, this is a remarkable number. And I think it might be one reason why we're seeing a little bit of weakness in the internet. That people are beginning to, I'm not saying they're going to run away from shopping on Amazon and Chewy and eBay, but they're going to their local stores and big box stores, and they're spending money there too, and walking it to their car. PMI. This is Purchasing Managers Index. We've talked about how the supply chain needs to reload. Well, here it's still reloading. Prior number, the consensus was it'd be about the same. Comes in stronger and blows out the consensus range. Factory orders. I included this one. Technically, we were still within the range, but the revision was so big from last month that if you add the revision together with how far above the consensus we were, it would put us out of the range. So for whatever, factory orders just we needed to look at this number. It's absolutely fabulous. A 2.6% number, really strong. And then today's number, now there were a lot of naysayers, and this is not an awesome report. There are some issues with it. But at least on the top line, we'll look. Prior number was revised much higher, over 100,000 higher, and then the actual number not only blew out the consensus but blew out the range. Now, one of the very first headlines that I saw on financial media had a subheadline that said something along the lines that most of these jobs were bartenders and wait staff. And,
okay.
and that's not an error. I mean, it is true.
And it's not a bad thing either, because they've been the ones that have gotten screwed by this whole process.
They're going back to work.
Yeah.
And that's great. So yeah, we shouldn't. I mean, it's really denigrating to those people.
Yeah.
To have that as like, well, this is a caveat for what's otherwise a great report.
Yeah. Oh, it's a bunch of workers at airlines and stuff like that. Okay, that's a good thing.
So there, but it does have a couple of issues down here that I'm going to get into. But we ticked down a little bit in unemployment rate. The private number was again better. Private payrolls came in. It's almost 500,000. I mean, it's a big number. Manufacturing was supposed to be barely positive enough to overcome last month's contraction. Comes in above the range and more than makes up for the last month. The participation rate, though, this is a little bit concerning that the participation rate didn't change. So, these jobs didn't result in people coming off the sidelines. And so what I think it basically said, they abandoned a side hustle to go back to work at a restaurant, something along those lines. So it's not as huge as these numbers expect, when that would lead you to believe if the participation rate stays the same. And that's just, again, participation rate, for those who aren't familiar, this is just the number of working age adults that actually have a job. So this is 61.4% last month. And so even though there are 500,000 or 400,000 more people having jobs, the rate didn't change. So how could that be? Well, part of it has to do with the machinations of how they compute this, and are people looking for jobs and what have you. But it also is how they classify full-time work. And I'll add to that, if you look at the average hourly earnings actually went down a little bit. So the prior number had been year over year 5.4%, and it ticked down to 5.3. So that does buttress the narrative that these latest jobs were lower paying, because normally you would expect, if you had a big blowout number of high paying jobs, that you would see this average hourly earnings number really push upward, and it actually came down. And the same thing with the average work week. I made a point last week of digging into the average work week being 35 hours, because I hadn't seen it that high. And then it turns out it really wasn't, because they revised it down a tenth. But then again, despite these other numbers up here, the average work week came down. And again, if you look at the kinds of jobs that were created this month, it would support that those are the kind of folks that typically work a shorter week in terms of hours. So some good and some bad in here. You can't just
I look at it good, because it's a release of strain on the system from everything around unemployment and everything else that we're stimulating the economy with, which of course we're got all this happening, and then you've got 1.2 $9 trillion yeah, stimulation for the economy that's going to happen. It's like, okay, it's already getting stimulated. We don't.
Yeah, and that's part. Yeah, and that's part of the whole issue with rates. Is
Yeah,
the market's looking at an already hot economy. Even if the financial press and the regular press are trying to convince people that everything is, is barely going and that we need stimulus, the market knows that we're doing pretty well, and that more stimulus is going to create enough heat that's one of the reasons, a big reason why we're seeing bond rates go where they are.
Okay.
And we're around to here. So I'm going to switch gears for a second and go over to our coronavirus tour, because that is a big part of the economy opening up, and particularly restaurant and wait staff people getting back to their jobs. You and I were talking beforehand about how Governor Abbott, kind of a tease in a way. I mean, he lifted the restrictions this week, but they don't take effect until next week. So I was like, well, why do we got to wait a week?
Well, I thought the funny part was my wife actually caught this, and she's not a native Texan. She goes, "Did you know today was Texas Independence Day?" And I'm like, "That's why he did it. It was Texas Independence Day."
So he wanted to make some kind of, yeah, you're right, March the 3rd.
I don't think he made. I don't know if they consciously did it. It was like out of the blue that they did it, but I mean, it was on Texas Independence Day that it happened. So,
well, I've been hearing for a couple weeks that he was going to do it.
Yeah.
So I thought the tease was, well, we're going to do it within a couple of weeks, and then, he would do it, but then for some reason we got to wait another week. But, we're also talking that, especially for people who live outside the state that might be watching this, the big box retailers and a lot of businesses aren't going to change their policies just because of what the governor said. So I think that the real world experience of wearing masks and not wearing masks and what we do, I don't think really anything's going to change, except for the fact that you might have to wait for a table at a restaurant, not because it's half full, but because it might be all the way full.
Absolutely. But then
not a bad thing.
But then the ludicrous thing that we were talking about prior to that, you get out of your car, don't wear your mask up to the door, put your mask on, go inside the restaurant, and take it off, which makes no sense to me. But
you really only wear the mask for the hostess.
That's exactly right. So they're the safest people in the restaurant here.
Excuse me. Interesting thing here, our COVID tracking project.
Yeah.
This is the last time we're going to see this.
Oh.
They put an announcement on their website earlier this week that they have arbitrarily decided that Sunday is going to be the last day that they're going to take any data in. So since they've said it's basically because that's their 1 year anniversary. They started this website on March the 7th of 2020, and I guess they feel like it's outlived its usefulness. I don't believe that. I don't know.
I thought it's been actually one of the more accurate ones all along.
It has, but I as I look through this website, I don't see any banner advertising or anything. It's I mean, they probably could have made some money off this, but maybe they just didn't. But anyway, you can even see over a week ago, we're hospitalizations are down, to 44,000, and that's as low as it's been since going back to I think it was September. No, it was late October.
Yep.
Yeah. So again, the skew, it was October 27th here was the last time hospitalizations were that low. the peak was on January the 6th. So we're coming down faster than we went up.
Mm.
One other thing that I thought was intriguing before we go away from this was this had the best way of showing you new tests. The last time we had as many as 2 million tests in a day was in January.
Okay.
Um, there's some days like here in mid-February, 1.1 million.
Mm.
There's another 1.1 million there. 1.1 million earlier this week.
Mm.
They're not. It's not for, we've demonstrated going back several months that we have the capability of administering 2 million tests a day. They're just not the demand to do it.
Yeah.
So that tells you that there's just not that many people that are even questionable enough to test.
Mm.
And then last but not least, to look at the USA's data, and I'm just going to go to the bottom here and here's the peak again. If we use the 7-day moving average, the peak was, January the 12th at 255,000. We're down to 65,000 now. That's almost 75% reduction. Very close to it. And the number of deaths has come down, amazingly enough as well, from a high of, 3442 a day to 1871. So almost in half on deaths, which, there's been a lag time between cases and deaths on both sides of the peak. So generally, great news there. And actually going all the way back here to this, it's going to take me a second to update this, for some reason, when I go to this Our World in Data website, every time I go there, what the heck? How did I get to the bottom? Wow. Boy, I gotta reset everything to just the United States. But here, we're up to 25% basically as of yesterday of people.
I mean, yeah, and you got to figure, they talk about that part, but I'm like, there was at least what 25 million people that have been diagnosed with it. So I mean, we're at 50 million people basically that either have a vaccine or
Oh no, we're way
COVID.
above that.
Yeah.
Here that was percent. That's per
Okay.
100 is 25. No,
All right.
the number of shots was at 82 and a half million.
Okay, yeah.
Some people have gotten 2, but about a quarter of the population has at least gotten 1 shot. And then even the CDC will tell you that even as we've gotten about 30 million people had a formal COVID diagnosis, the real number is well above that. So
Sure.
We're comfortably, according to the way the CDC looks at it, if there's at least a 3-to-1 ratio of overall COVID cases compared to diagnosed COVID cases, and I think their number is closer to 6. But even at 3, we're at about half of the population. So, quite a bit of the population. So there are some people that are talking about, herd immunity and that we might be knocking on the doorstep of it. I had said several weeks ago on this program that I thought it would be by the end of April. And it could be, it could be sooner than that.
Yeah.
But I'll certainly stick by the end of April because that's, things.
Yeah, just it's math.
We'll have everything about lockdown then.
Yeah. We don't like the term lockdown. Please don't use that.
No. Right.
Lockdown bad.
So just to wrap things up, kind of with how the markets are digesting the growth, how they're digesting the stimulus ideas, uh, attitudes towards the markets and everything else. I thought this was instructive to resurrect our fear and greed index.
That's come back since we looked at it the last time.
It's right now, it's right in the middle. It's neutral. I'm looking at this 1 year ago was extreme fear.
Yeah.
It was down to -9. And if you actually look at the graph at the bottom, you can see how low we got in early 2020 with extreme fear.
Yeah.
And the lowest number I saw was 2.
Hmm.
And I think that was on the date that we hit the low, which was March 23rd.
Yeah.
So, we are seeing, and again, we've talked about the growth and value dichotomy, that value seems to be outperforming growth here in 2020, and certainly over the last 8 weeks. Interestingly enough, earlier today, the NASDAQ was down while the Dow was up. Now they're both up very strong. Reiterating what we were saying at the beginning of this cast. That's I'm still seeing the 10-year yield is still sitting there at 1.55. But the NASDAQ earlier today actually went into correction mode, which was more than 10% off of its recent high. It hit its all-time high here, just almost 14,100 on February the 12th. And earlier today, we were as low as 12,400. So if you look at the intraday low, and we're at 12,906 right now, the NASDAQ's had a 500-point swing from this morning. I mean, that's an enormous number.
Crazy.
If you push that out, it's about a 4% swing from bottom to top. I mean, it's a huge number. And usually intraday swings like that, especially where they close, very strongly after weakness, that's very positive for stocks of all kinds. I was looking
and
at
especially,
Tesla.
especially in a volatile week going into the weekend, a lot of times you'll see the market kind of sell off a little bit, just like, hey, we got something back now. We're going to capture it. But yeah, it's pretty interesting going into the end of the week like this.
Yeah, and to be a mirror image of last Friday as well.
Yeah.
I don't own Tesla. Maybe I should have. I guess I probably should have.
I do, and it's been a little painful here lately, but still positive.
Yeah, it was. But I mean, this stock hit 880 on a closing basis, and the 52-week range actually touched 900.
900, yep.
And earlier today, it was down to 540. So it's rebounded about $60 a share, which is over 10% from where it was at about 11 o'clock this morning.
Yeah.
So, it's still down on the day, but it's not down nearly as much as it was. I mean, look at this one-day number. I mean, we went from 540, says 539.49, to over 600. Pretty remarkable day. But again, overall, we're still seeing, even today, as you look, if you want to call the Dow Jones Industrial the value index compared to the NASDAQ, the Dow is up 1.8%, NASDAQ's up 1.5%. The Dow is much closer to its 52-week high than the NASDAQ is, even given what the NASDAQ's done here in the last several hours. So I tend to believe that this growth versus value shift is real. We're seeing it in some of the numbers, just going back to that ISM services number, and then kind of looking at it with comparing to, say, construction, factory orders, durable goods, those kinds of real things, which tend to be in the into the value end camp. Um, so um, I was going to sign off, and then I just remembered that you had said that something about the dollar, and I don't want to sign off without talking about the dollar a little bit. The dollar's been sneaky strong in the last couple of weeks, and a big part of that is the yields that we've been talking about on treasuries, because you know, uh, if you compare yields on treasuries um, with those that are available um, in um, foreign markets, you know, they're just, there's no comparison. I mean, you go to Japan or Europe, there's still negative yields in a lot of cases. Um, Look at yeah, this is all. Oh yeah, here we go. Um, so the UK, I mean, 75 basis points. The German 10-year is still a negative 0.3.
I still can't wrap my head around. I'm going to pay you to take my money.
Right.
I just, somehow that just does not resonate with me very well.
Yeah, I guess, you know, you don't want to have a vault that somebody could break into. So,
Yeah.
um, but anyway, so the rates are a big part of the dollar strength, but you know, the rates, you know, are a dichotomy themselves between, you know, some of this fiscal, you know, irresponsibility, really, that this latest stimulus bill, which is not necessary.
Mm.
Um,
And it's by no means a COVID stimulus bill.
no, and we've talked about it. I said within hours of it coming out that there was not going to be any there's not going to be any compromise. It's going to be 1.9 billion. It's trillion. It's going to be what the Democrats want. I mean, the idea that there's going to be any bipartisanship, you know, they talk about it in the press like it's possibly going to happen. It's not going to happen.
No.
This is going to be a Democrat bill that is going to be 1.9 trillion, and the market fears that, so it's pushed yields up, and it's also going to help to overheat an already hot economy. Europe, Japan, other markets aren't having that kind of heat.
Yeah.
And so the differential between the real economy and then the pressure on rates because of fiscal policy is, I think, both of those are combining to push the dollar higher um, relative to the basket of currencies that it's marketed again, or compared to when you see this dollar index and the euro on the, say, the Wall Street Journal's website. Anyway, that's kind of to wrap it up this week. Oh,
what about the most interesting thing?
Most interesting thing. I can't leave. I'm going to have to switch back to. Are you seeing Moody's chart?
Yeah, I see the Moody's chart.
Okay.
Yep. Aha. Tom,
we've been talking about this, and yes, you've seen stuff in previous weeks. I do like big ships, but and you know, we have also talked about the chip shortage, which I think has gotten a lot more play than what we're seeing in the real world of shipping and supply chains and what have you. And both of these is that for various reasons, we're seeing a huge log jam in container shipping around the world. There's a container shortage. There are ships that are you know, that are delayed. We showed a couple of instances where we're seeing these really big ships are getting into storms and losing fairly large numbers of containers overboard, and so they have to turn around and go back where they came from for repairs. And of course, you're not getting the stuff back that went overboard. So uh, all of this, I want to keep a focus on this. I don't know as if I can draw any firm conclusions yet. My gut is telling me that with the number of accidents that we're seeing with these really large ships, and how many containers they have, like this guy right here, how many containers are on board, how high they're stacked up, how top heavy these things can be. You get into the middle of the Pacific Ocean, um, and stuff can come off. So my gut's telling me that we may be starting to see like the limits of how we can have our current supply chains configured. And I just don't think a lot of people realize that pretty much everything that you get in Walmart is in one of these boxes right here. I mean, outside, unless you shop at the Walmart grocery store. I mean, but most of the other goods in big box retailers that come in from China and come in from made in Vietnam, and some of the other Pacific Rim companies, they're all coming to the United States in containers like these. Very few things, and they're only really very high margin, very expensive items go by air freight. So, you could see some rare chips or computer chips, that is, that would come over air freight, and medical goods, and uh, something where somebody's willing to pay a giant premium. But for the vast majority of things, you've got you ship it, you put it on a boat that looks like this, and it comes across, and we're seeing huge delays in Long Beach, huge delays in the port of Los Angeles, really up and down the West Coast, which is the coast that faces all of the producers in Eastern Asia. Um, and I think the longer that this persists, and particularly the issue with the accidents that we're seeing, um, our ship's getting too big. And then, of course, the climate change crowd can chime in here. But if we really are seeing a much more active climate that is going to give us stronger storms with bigger wave heights, these ships are going to be impacted.
Yeah.
So is that another reason why, in addition to some of the political and geopolitical reasons behind rethinking China and maybe shortening supply chains, that some of the real world shortcomings of the shipping system itself may help to sharpen some thinking in that regard. And this would be a boon towards onshoring manufacturing, or at least getting it back into the Western
into our
hemisphere.
hemisphere. I mean, you've got Mexico and Central America that you could potentially do manufacturing in,
Yeah,
like that, and take that risk out of having to, shoot it across the oceans.
yeah. So
Yep. All right. Well,
that's something
pictures of ships.
I'm
That's
just going to predict. I can't be sure, but I think that's an issue that's going to have legs. And I think we're going to be talking about shipping from a number of different dimensions for some time. And I remember talking to people, especially a lot of globalist type traders that almost viewed shipping for a long time in the 20 teens as it was almost free. Like, you didn't really think about cost of shipping something from China to get it to LA or Long Beach. And that's not the case anymore.
Yeah.
And it's gonna, if it persists the way it is right now, I think it's going to cause people to change how they really configure their supply chains.
It's interesting. Gives us
interesting enough for this week.
most interesting thing for this week. Well, Tom, thank you so much. Great stuff again. Thanks for putting all this stuff together for everybody. Folks, we really appreciate y'all listening. We're out there on all the podcast channels. You can check that out. Wherever you're watching this, we are on YouTube, we are on Rumble, we are on the podcast channels like Apple Podcasts and Google Podcasts and Stitcher. And of course, we're on Podbean. So wherever you're at, please make sure that you subscribe to the channel, as well as give us a rating. Hopefully that's a 5-star so that we can continue to get out there in front of people. Please share this podcast with other folks. We'll be back next week. We do have 2 shows a week that we do. One is, an interview with entrepreneurs, and another one is the finance show that we do on Fridays. So thanks a lot. We'll see you back here next week.